Hi, my name is Frank Fahey of Discover Options in the Tall Grass Funds. Today I'm going to talk about the very basics of trading implied volatility. The basic exposure we all have to implied volatility is a measurement called the VIX. We see it on TV, in the paper. What the VIX is a measurement of the daily implied volatility of the S&P 500. It is a cash price. Louis Pasteur said, chance favors the prepared mind. What that means is you need to know what you're trading. That's what it means in our environment. I've been getting calls from people saying, Frank, I want to buy the VIX. We're at all-time lows. It's going higher. Well, quite frankly, they're talking about that cash number. The CBOE / Chicago Futures Exchange has a contract which is called, based on the S&P 500 implied volatility. It's based on a future, a monthly future, September, October, November. The September future is a VXU2. That's September 2012. 2 days ago, that future was trading 18.5. The cash price was 14.5. The people calling me and say, Frank, how do I buy this? Are expecting to buy that future at 14, or the VIX at 14.5. But if they are going to trade that, they are going to buy a product based on a future at 18.5. They buy the future, it's 18.5. It's looking out 30 days. If they buy an option, that option is based on the underlying being at 18.5. Other alternatives or approaches to trading the VIX, or implied volatility, is a product called the VXX. The VXX is an ETN based on daily roll of 2 months, the front 2 months of the VIX future. In this case, it would be the September and October future, and we would move 1 day forward at a time. There are options on the VXX also. In addition, there's in the inverse of the VXX, which is called the XIV. That is also an ETN. The important thing to remember is if you trade any of these, they are not the same as trading the VIX. They're complicated. They require a certain level of understanding and sophistication when it comes to trading. There are numerous sources of getting this information. The primary source, as always, is the internet. Unfortunately, the information provided on the internet is incorrect, incomplete, and sometimes just pure and simple wrong and a guaranteed way to lose money. I would suggest that you go to your favorite options education source, whether it be Market Trader, the Options Industry Council, the Chicago Board Options Exchange, or Discover Options, and learn as much as you can about implied volatility, historical volatility, and trading implied volatility. The next step is to go beyond what you can learn on your own and hook up with a mentor / trading environment where you can have a one-on-one explanation of the implications, the pitfalls, and the risks and the rewards of trading implied volatility. Looking forward to talking to you about this in the future. Thanks.